At some point, though, Joe, you've got to decide what you're willing to pay for all of the attributes that Weiss was talking about for, these companies that are betting big on this transformational technology. Sacconaghi over at Bernstein says he struggles to recommend an overweight for tech because they're expensive on an absolute or historical basis. We gave you what the 10-year averages are versus what they're trading at today. Apple is 10 times higher, or 10 points higher, 18.9, 10-year, 28 today. Told you what Microsoft is as well. Jonathan Krinsky, BTIG, is saying that the NASDAQ's showing signs of exhaustion, these mega caps are, so the bar's even higher.
I'm not sure I see the signs of exhaustion just yet. I think that there still is, as Steve mentioned, there's demand underneath the market when it appears as though we're about to enter a corrective phase. The buy the dip mentality still seems to be in place. I'm going to say something that I'm sure is going to be greeted with a lot of skepticism and probably a degree of criticism. But we keep looking at these mega cap companies and we keep referring back to the historical valuation of these companies. Maybe that's the wrong exercise. Maybe it's the wrong exercise to think about these companies in the past and not realize that maybe there's a valuation reset going on given the advancement of the innovation.
Well, not maybe. I think your point's well taken and fair. I mean, there obviously has been a valuation reset for some of these companies. The question is, are we putting the cart before the horse? Are we assuming that they're going to reap the rewards and benefits that the market has already priced in for many of these names? Now,
but the earnings have supported that today.
Well, Microsoft and NVIDIA are proving to be able to monetize AI in a way that some of these others aren't. Those rising tides have lifted a lot of boats. Now the proof's in the pudding as to whether the boats deserve to be at the same level with those yachts.
Yeah, but specific to Alphabet, specific to NVIDIA, specific to Microsoft, there's enough clear evidence there to suggest that we might see valuations grow even richer than where they are now, and it is warranted. So I just think be careful relying on a historical valuation exercise to determine your positioning in a particular mega cap. Not the derivatives off the mega caps.
I got you. You want to weigh in on that, Bill? I mean, because you have your top holding is Amazon.
Yes.
Your number 2 is Apple. Your number 3 is Alphabet. Your number 5 is Microsoft. So you're all over this week. You better hope they go well.
Yeah, I mean, I really do hope they go well. I think they can. And one we haven't mentioned is Amazon. And Amazon's the highest multiple of the entire group. And I really think here, if they've been seeing some really great tailwinds with margins in retail, as well, the juggernaut of AWS. I mean, if we continue to see revenue growth at that pace and better, I think what we're seeing is the multiples will continue to come down as we look out, and those are going to be a continued tailwind for the market, and that's huge for these big names right now.
Well, AWS has really, Weiss, I think, it's changed the game in terms of how you read where Amazon is trading. Amazon's always been at a historically expensive valuation, and in the past you're like, wow, I'm going to pay 100 times for a marketplace business. I mean, how much can that really continue to grow? But AWS has changed the game enough that the forward PE on Amazon today is 42. It's not the triple-digit one that it's lived with for most of its history.
Yep, exactly. And think about it now. The vanity projects are gone. They've gotten religion, like all the other tech companies coming out of the pandemic, on spending. So Jassy has done a very good job of allocating capital to each business. And when you look at AWS, growth started to pick up again. We had a slowness. All cloud growth just hit a wall last year, but now it starts to reaccelerate as we saw the last quarter. What's lost in this conversation, though, is AWS signed a $10 billion contract with Microsoft to use their tools in their cloud business. So when you take a look at cloud, we've been talking about it for more than a decade, but still, it's less than corporations around the world are still less than 30% of the cloud right now. So you've got that massive transition that's going to continue and accelerate as more computing power requires more cloud usage. So that's a big, big tailwind. But, just go back to my prior comments. I would say to Krinsky that that when you cite the numbers, performance of mega cap tech this year, it's hard to say it's exhausted. It's anything but. But I do think at some point it's only natural to see a pause in the acceleration in the market. Will this quarter's earnings give it reason to have that pause? Maybe. But we can't keep going like we are right now. Now, what could make me wrong? What could make me wrong is the Fed really changes their language. Well, what could make me wrong also, on the other side, is if the U.S. goes into Iran, and that'll be a knee-jerk reaction, because then think what happens. That's the real canary in the coal mine, because then oil prices will spike, and what's the Fed going to do? That'll drive inflation. So it's not like it's 100% clear ahead. There are some issues that can cause the market to be disrupted for a short time.